In 2026, climate change has transitioned from a future projection to a primary driver of real estate appraisals. The market is no longer pricing homes based solely on square footage or school districts, it is increasingly pricing them on resilience. As insurance companies exit high-risk markets and climate gentrification takes hold, we are seeing a dramatic divergence in property values. Areas once considered affordable havens are facing insurance-driven price stalls, while climate refuges are seeing unprecedented demand. Here are the 7 U.S. regions where climate change is fundamentally altering the property price map. 1. The Florida Sun Belt, sea level and insurance stalls. Why number 1, Florida is the epicenter of the insurance equity trap. In 2026, the state faces a projected $1.4 trillion in property value exposure. While beachfront luxury remains high, the middle-market residential sector in cities like Miami, Tampa, and Jacksonville is seeing price stagnation. For the first time, more than 50% of Floridians are seriously considering moving due to the combined pressure of skyrocketing premiums and flood risk. The premium surge, insurance costs in Miami have risen by over 300% since the early 2020s. This invisible mortgage is effectively lowering what buyers can afford, forcing sellers to drop prices to compensate for the higher monthly carrying costs. The flood discount, recent 2026 data shows that homes in high-risk inundation zones are trading at a 10 to 20% discount compared to nearby properties on higher ground. The market has moved from ignoring the risk to pricing it in with cold precision. 2. The California Wildfire Corridor, supply shocks. Why number 2, California's real estate market is being reshaped by the burn perimeter. In 2026, nearly $1 trillion in property value sits in AI-identified high-risk zones that federal maps still label as low risk. Following the devastating 2025 fires in Los Angeles County, the inventory of homes for sale in surrounding areas has surged by nearly 200%, as second home owners and panicked residents look to exit. Inventory saturation. In fire-prone regions, the supply of homes has spiked, but demand has cratered. This has led to a price dip of 1.7% in the LA metro fire zones, while safe, buffer zones are seeing price increases due to a sudden shift in local demand.
Wildfire rebuilding efforts here in Southern California. President Trump has signed an executive order the White House says aims to speed up reconstruction in the Palisades and Eaton Canyon areas.
Will have to live because they have not been allowed to start rebuilding. They are still paying the mortgage on a burned lot, and she says until the federal order turns into shovels in the ground, nothing changes. It's not because their home in Altadena is ready, it's because she's out of options. Her house burned to the ground in the January wildfires.
The severe label, 94% of properties destroyed in recent fires were identified as extreme risk by private climate data firms but not by government maps. In 2026, savvy buyers are ignoring state disclosures and paying for private climate risk audits before making offers. 3. The Arizona desert, water scarcity and heat penalties. Why number 3, in 2026, Phoenix and Yuma are testing the limits of livability arbitrage. While the market is still booming due to investor interest, the state's requirement for developers to prove a 100-year water supply has created a supply bottleneck that is artificially inflating the price of existing homes while devaluing undeveloped land. The heat index cap, counties like Maricopa are seeing a 30 to 40% increase in days above 110 degrees Fahrenheit. This is beginning to dull the attraction of the desert. While prices are still growing at 3.9%, outbound migration to cooler states like Colorado is at an all-time high. Insulation costs, the cost of climate-proofing a desert home, including advanced HVAC systems and heat-reflective roofing, has become a major factor in price negotiations. Homes lacking these extreme heat upgrades are seeing slower appreciation. 4. The Gulf Coast, chronic inundation and wealth gaps. Why number 4, across the Gulf, from New Orleans to Mobile, structural discount has emerged. Properties at risk of chronic flooding are now selling for an average of $75,000 less than comparable safe properties. In 2026, this climate disaster penalty is widening the wealth gap between at-risk and flood-free households. Slow growth penalty, while national prices are stabilizing, Gulf Coast homes in flood zones are growing significantly slower than the national average. This compounding value gap means homeowners in these regions are losing out on the primary engine of middle-class wealth, home equity. Amenity versus risk. In premium markets like the Sunshine Coast, the desire for water views still outweighs the perceived risk, creating a real estate bubble where values remain high despite clear data suggesting future inundation. 5. The Great Lakes Refuge, climate migration inflows. Why number 5? The Midwest is the beneficiary of climate flight. Cities like Buffalo, Cleveland, and Detroit are being marketed as climate havens. While they are not immune to storms, their lack of wildfires and sea level rise has made them a target for institutional investors and out-of-state refugees from California and Florida. Gentrification pressures. In 2026, corporate speculators are buying up working-class neighborhoods in Toledo and Cleveland en masse, betting on long-term climate migration. This is driving up prices for locals, who are being priced out of their own safe markets. The preparation premium. Cities that are actively climate planning, like Ann Arbor, are seeing higher property appreciation as buyers prioritize municipal resilience over raw square footage. 6. The Tornado Alley Shift, convective wind risk. Why number 6? Traditional Tornado Alley, Oklahoma and Kansas, is seeing its real estate market hammered by the rising cost of wind and hail insurance. In 2026, homeowners in high-risk zip codes are paying premiums 80% higher than the national average. These costs are beginning to eat into homebuyer equity and mortgage serviceability. Asset erosion. Severe convective storms are now the #1 cause of insurance non-renewals in the mid-country. Homes that cannot secure private insurance are becoming unmortgageable, leading to a collapse in value for older, less resilient structures. The resiliency premium. Homes built with modern, storm-resistant, impact-rated materials are now selling at a 5 to 10% premium, as buyers recognize that the cost of future repairs is now a near certainty. 7. The Northeast Coast, Managed Retreat and Superfunds. Why number 7? In 2026, states like New York, Vermont, and Connecticut are implementing climate superfunds, forcing fossil fuel companies to pay for infrastructure upgrades. In coastal New England, this is leading to managed retreat programs where the government is essentially buying out high-risk properties to return them to nature. Valuation volatility. The threat of a superfund or managed retreat has made coastal valuation volatile. In some Connecticut towns, property values are fluctuating based on the latest state-funded flood mitigation project. The wealth effect. Unlike the South, the Northeast is seeing a policy rebound. Markets that have high government investment in seawalls and drainage are seeing prices rise, as they become the only guaranteed safe coastal options in the region.